This is the answer for exercise 4.1 of group 6. This question asks us to estimate the beta, alpha, and cost of capital for the large co portfolio and also evaluate its investment performance. I imported the data that's given in the question of the rates, and then I ran a regression to calculate the alpha and beta. As you can see, the function, the alpha is the coefficient of x, and the beta is the coefficient of x, and the alpha is 0.0007, which is 0.07% per month and 0.84% per year. According to the result of alpha, we can say that the manager has earned a return higher than cost of capital, which is a positive abnormal return. As the risk-free rate is given as 4%, and we use the market premium of 7%, which is the average market premium of US from 1926 to 2008, we can calculate the return, the cost of capital with this function.
The question 4.2 is false, because early stage VC doesn't necessarily earn a high expected return. It has a higher feature rate, which means it has a higher probability to lose money. However, it also has a higher chance to earn back a large amount of money. Therefore, we can't tell whether it can earn a higher expected return or not.
Chapter 6, Question 1's statement that private equity is a substitute for public equity is false. Historical records have demonstrated that IPO markets induce more VC activity. When a company receives private equity, it not only receives capital, but also enters into a relationship with the private equity firm. Under this relationship, the private equity firm aims to make the company more efficient and seeks to maximize a company's value before selling it for a profit. Contrast to this, public equity, at least in a non-institutional investor's perspective, entails providing capital to a company, but usually in a passive way, as in the investors do not seek to be activist investors the way that a private equity firm would.
For question 6.2, the statement should be false. Countries with common law-based legal system have relatively strong protections, and according to the research, the ratio of total stock market capitalization to GDP is strongly related to self-dealing index. Moreover, the average self-dealing index in common law countries is lower than the civil law countries.